Hey guys, I'm going to go through 4 reasons that you may not want too many tax deductions. So the first reason that you may not want too many deductions is because of net operating losses. So net operating losses are essentially when you create more deductions than you have income. So from a tax standpoint, you have an overall loss. Prior to the 2017 Tax Cuts and Jobs Act, you could use 100% of that net operating loss to offset income in the next year. The 2017 Tax Cuts and Jobs Act changed this so that you could only offset up to 80% of your taxable income with a net operating loss. In this example, you have year 1, you have $1 million loss, which is an NOL. Then in year 2, you have $500,000 of income before considering the NOL. So you had a carryover of $1 million from year 1. So now your limitation, because remember, you can only offset 80% of your income with the net operating loss. So essentially $400,000 is your NOL deduction for year 2. So your net means that you're paying tax on $100,000 still. If you look at the years in total, you have $1 million NOL, you have $500,000 of income. Combined, that's a $500,000 loss, yet you're still paying tax in year 2. So sometimes instead of creating deductions with various tax planning strategies in year 1, or accelerating expenses or taking bonus depreciation, there may be reasons why you want to push that into year 2 and spread it out more. Ever since this tax law change, it's essentially like walking a tightrope. You don't want to create too many deductions, but you also don't want to have income and pay tax a lot of times. So you really have to be more precise on the tax planning. The second reason you may not want to create too many deductions is because of passive loss limitations. So rental real estate by default is passive. There are exceptions to that, like active rental real estate, or if you're a real estate professional, or you may be passive because you're invested in a business, but all you did was put money in. You're a limited partner, you're a silent partner, you're not making day-to-day decisions or managing the entity. And so there may be possible deductions coming from there, but you may not want the partnership to accelerate them because you can't always offset your income. Let's say you have $100,000. So this is from your W-2 job that you're active in. You have a loss of $10,000, but this is from a passive activity. Well, because it's passive, you can't actually use the $10,000 to offset your $100,000 of income. You're still paying tax on the full $100,000 of wages. Any more deductions that you throw in this passive activity isn't going to help you this tax year anyway, until you have income you can offset. So passive activity losses can generally only offset passive income. If you dispose of the passive activity, meaning you sell it, maybe sell it to another partner, then that would release those passive losses against even your other active income. Third reason that you don't want too many deductions is actually not a tax reason. It actually has to do with lending. The lender is looking at your tax return. And the reason they're looking at your tax return is because that's what you're reporting to the government. And so they feel like that's the most trustworthy source of information telling them how much income that you're generating. And then based on that, they're going to apply their ratios. So if you create too many deductions, so if you're trying to accelerate expenses, you buy a lot of equipment before a year end or something, to reduce your tax burden, well, the lender is going to see that and they're going to take that into account when they're deciding how much they're willing to loan you or if they're willing to give you a loan at all. So if you know that you're going to be refinancing, you're going to be getting a loan on something, you really want to be cognizant of the deductions that you're using on your tax return to make sure that in a holistic view between trying to reduce your taxes and trying to get the capital that you need in order to make certain investments or improvements, that you're making the right decision. The last reason that I'm going to talk about for why you may not want too many deductions may only apply to higher income type individuals, but I still see this happen quite a bit. And this is the excess business loss limitation. The excess business loss limitation essentially says that you can only offset a certain amount of your regular wage income, interest, dividends, which are portfolio income, with business losses. If you create too many business losses and you're not able to offset all that income, it carries over, but it translates into the next year. It's treated as a net operating loss. So going back to our first example on limitations that are applicable to net operating losses, creating too many deductions and creating an excess business loss will actually hurt you also and subject you to that 80% limitation that net operating losses have. For 2023, the limitation is $289,000 for single taxpayers, $578,000 for married filing joint. These numbers change every year because they are inflation adjusted. So let's do an example of a single taxpayer. They are a shareholder, but they're taking wages for the efforts that they're doing. And then they're also getting a K-1 from the S corporation reporting the pass-through income that they are generating $400,000 of wages from the business. And then let's say they made a lot of investments. They bought a lot of new equipment, which they were able to take bonus depreciation on for 2023. On the K-1 flowing through, they had $600,000 of losses from the business. Well, our limitation says that single taxpayers can only create up to $289,000 of business losses against their active income. That leaves them $311,000, which is now going to be a net operating loss subject to that 80% limitation going forward. So it may have been better in this instance if they got closer to creating a loss in the business of only $300,000 to offset as much of their wages as possible. And that way they wouldn't have any amount carrying over as a net operating loss. Instead, they could shift that $300,000 if that was equipment deductions into the next year, and it wouldn't be treated as a net operating loss. It wouldn't be subject to that same limitation. Those are the 4 reasons why you might not want to create too many deductions. Again, I went through these really quickly. So if you need more detail and had a hard time following along on some of the specifics, let me know. I can do another video. But really, this is important for you to ask your CPA. I'll see you guys in the next video.